Imagine moving $300 automatically into an index fund every month. No stock picking, no crypto, no market timing, just a simple, consistent plan. By the end of this video, you'll see exactly what happens to that $300 over 10, 20, and 30 years. You'll meet three people who made the same investment but ended up in very different financial realities. And you'll learn the one rule of compounding that can change how you think about money forever. Let's start with a number most people don't know. S&P 500, which tracks the 500 largest companies in the United States, has returned an average of 10.4% annually over the last 30 years. This includes major crashes like the dot-com bubble, the 2008 financial crisis, and the pandemic collapse of 2020. Despite all the ups and downs, the average return remains strong. For this video, we'll use a conservative 10% annual return to keep things honest and simple. Now, let's meet three people who each invested $300 a month. Aisha is 25 and starts investing $300 a month into a low-cost S&P 500 index fund. James is 35 and finally begins after years of waiting, and Linda is 45, starting after years of hesitation. All three use the same fund, same strategy, and stop investing at age 55. That means Aisha invests for 30 years, James for 20, and Linda for 10. Their journeys will show us how time, not just money, shapes their financial outcomes. Linda invests $300 every month for 10 years, never missing a transfer. In total, she puts in $36,000 of her own money. With a 10% annual return, compounded monthly, her portfolio grows to $61,453. That's a gain of $25,453, money she never worked for, created entirely by the market. It's 1.7 times her money in a decade, without picking a single stock. Linda's result is meaningful, a solid foundation built from consistent investing. In Linda's first year, compounding adds about $220 to her portfolio, less than $1 a day. The early years feel slow because most of the growth comes from her own contributions, but beneath the surface, something is building. By year 10, the market adds $5,500 in a single year, showing the first signs of compounding's power. This sets the stage for what happens to James and Aisha as they invest longer. James invests the same $300 every month for 20 years. Over 2 decades, he puts in $72,000, double Linda's contribution. With a 10% annual return, his portfolio reaches $227,811. The market adds $155,811 on top of his own money, more than doubling his contributions. His return is 3.2 times his money. The gap between James and Linda is striking. $166,358 difference, mostly due to time, not just money. Both Linda and James invested $300 a month, but James started 10 years earlier. Linda contributed $36,000 less than James, but ended up $166,358 behind. This mismatch shows how compounding multiplies the effect of time. The extra money invested is almost irrelevant compared to the extra time given. The visual gap between their portfolios widens dramatically, illustrating the true power of starting early. Aisha invests $300 a month for 30 years, totaling $108,000 over 3 decades. With a 10% annual return, compounded monthly, her portfolio grows to $678,146. She invested $108,000, but the market added $570,146, more than 5 times her contributions. Her return is 6.3 times her money. The difference between Aisha and Linda is $616,693, showing how starting early transforms financial outcomes. Let's look at Linda, James, and Aisha side by side. Linda invested $36,000 and ended with $61,000. James invested $72,000 and reached $227,000. Aisha invested $108,000 and finished with $678,000. The difference between Aisha and Linda is $616,693. Aisha invested only $72,000 more than Linda but ended up with 6 times more. The only difference, when they started. The most important part of this story is what happens in the last 10 years. At year 20, Aisha's portfolio matches James's final number, $227,811. But Aisha keeps going for 10 more years. In that decade, she deposits $36,000 more, and the market adds $414,336. By year 28, her portfolio generates more in market returns per year than her $300 monthly contribution. The investment is now investing in itself. This is the secret of compounding. The first 10 years feel slow because they are slow. The second decade builds momentum, but the third decade is when the machine takes over. The returns accelerate and the investment grows faster than your contributions. This is why long-term investing is so powerful. Time transforms your portfolio into a self-sustaining engine. There's a principle called the Rule of 72. Divide 72 by your expected annual return, and you'll know how many years it takes for your money to double. At a 10% annual return, your money doubles every 7.2 years. Every doubling adds more than the previous one. If you have $100,000, the next doubling gives you $100,000 more. If you have $400,000, the next doubling gives you $400,000 more. The time is the same, but the gains are much larger. Every time your portfolio doubles, the amount gained is larger than before. The first doubling might add $100,000, but the next could add $400,000. The compounding effect accelerates as your portfolio grows. This is why people who quit after 10 or 15 years miss out on the biggest gains. They stop right before the machine shifts into its highest gear, never seeing what was possible. Waiting 10 years to invest $300 a month doesn't just cost you $36,000 in missed contributions. The real cost is $450,336, the difference between Aisha's result and James's. That's what a decade of delay costs, measured in the portfolio you never build, not just the money you didn't deposit. James didn't lose $36,000 by starting late. He lost $450,000. And he only needed to deposit $36,000 more to prevent it. On screen, the gap between Aisha and James is labeled $450,336 for a $36,000 delay. This visual makes it clear that the cost of waiting is not just about the money you didn't invest, it's about the wealth you never build. Every long-term study on wealth says the same thing. The single most powerful variable in personal finance is not which fund you pick, not your expense ratio, not your income. It's when you start. Many viewers might think, I don't have $300 a month. If you're in financial triage, high-interest debt, empty emergency fund, or struggling with bills, then investing isn't the priority. Clear debt and build your emergency fund first. But for everyone else, $300 a month is just $10 a day. The math works at any number. $100 a month for 30 years at 10% becomes $226,000. $50 a month becomes $113,000. The principal cares about time and consistency, not the amount. If 10% feels optimistic, you can run the numbers at 7%, the inflation-adjusted historical return. Even then, $300 a month for 30 years becomes $365,991, which is 3.4 times your total contributions. The numbers change, but the lesson doesn't. Time and consistency are what matter most, not the exact return or the amount invested. Aisha is now 55, with a portfolio worth $678,146. She didn't get lucky or pick winning stocks. She simply started at 25 and didn't stop. James is 55, with $227,811. It's real, meaningful money, but he knows what it could have been if he'd started earlier. Linda is 55, with $61,453, a solid foundation, but she knows the difference. The one thing she tells everyone is simple: start right now. Not next month, not next year, not when the market looks calmer or when you understand it all perfectly. Start right now with whatever amount you can genuinely afford. Put it into the simplest, lowest cost index fund you can find. Set it on automatic and repeat. The sooner you start, the more time you give your money to grow. Aisha isn't exceptional. She didn't have a higher income, didn't catch a bull market at the perfect time, and wasn't more disciplined or financially literate than James or Linda. She just started 10 years earlier. That's the entire gap between $678,000 and $227,000, between financial independence and adequacy, between options and obligations. The only difference is time. The market doesn't reward intelligence consistently. It doesn't punish mistakes consistently. What it does reward, reliably and mathematically, is time. Consistent, uninterrupted, patient time. You can't buy time back or compensate for it with larger contributions later. You can only use the time that's in front of you. The best time to start investing was 10 years ago. The second best time is today. Before this video ends, consider setting up your plan. $300 first of the month, automatic index fund. Repeat for as long as you can. This simple plan can change your life or your children's lives depending on when you start. Setting up automatic transfers ensures you stay consistent. Whether the market is up, down, or sideways, your investment keeps growing. Automation removes emotion and hesitation, making it easier to stick to your plan. Over time, this discipline pays off in ways you can't imagine at the start. You don't need to pick the perfect fund or time the market perfectly. Consistency is more important than perfection. The market rewards those who stay invested, not those who chase trends. Stick to your plan and let time do the heavy lifting. Even small amounts, invested consistently, can grow into significant wealth over time. $50 or $100 a month may not seem like much, but over decades, compounding turns these contributions into life-changing sums. The key is to start and stay consistent. Many people wait for the perfect moment to start investing. They hope for a raise, a calmer market, or more knowledge, but that moment rarely comes. The real opportunity is to start now with what you have. Waiting costs more than you realize, and the sooner you begin, the more you gain. The difference between financial independence and adequacy is often just time. Aisha's early start gave her options at 55, while James and Linda have obligations. The market rewards patience and consistency, not luck or intelligence. Your financial future depends on when you start, not just how much you invest. Index funds are simple, low-cost, and effective. They track the market and require no stock picking or market timing. By investing in an index fund, you benefit from the overall growth of the economy without needing to be an expert. This makes them ideal for long-term, automatic investing. Trying to time the market is risky and often leads to missed opportunities. The most successful investors are those who stay invested, regardless of market conditions. Automatic, consistent investing removes the temptation to time the market and ensures you benefit from long-term growth. Discipline is crucial in investing. Setting up automatic transfers and sticking to your plan, even when the market is volatile, is what builds wealth. Emotional decisions can derail your progress, but discipline keeps you on track. Over time, this pays off in ways you can't predict. Compounding is the process where your investment earns returns, and those returns earn more returns. Over time, this snowballs into significant wealth. The longer you stay invested, the more powerful compounding becomes. It's the secret behind every successful long-term investor. Before investing, it's important to clear high-interest debt and build an emergency fund. Investing while carrying expensive debt can undermine your progress. Once your finances are stable, consistent investing becomes the next step toward building wealth. An emergency fund is your financial safety net. It protects you from unexpected expenses and allows you to invest with confidence. Once your emergency fund is in place, you can focus on consistent, automatic investing for the long term. Long-term investing is about patience and consistency. The market will have ups and downs, but staying invested ensures you benefit from overall growth. The stories of Linda, James, and Aisha show that the longer you invest, the greater your rewards. Whether you invest $50, $100, or $300 a month, the principle is the same. Time and consistency are what matter most. Even small contributions, invested regularly, can grow into substantial wealth. The key is to start and stick with your plan. If you're concerned about inflation, remember that even at lower returns, consistent investing still builds wealth. At 7% annual return, $300 a month for 30 years becomes $365,991. The numbers may change, but the lesson remains. Time and consistency are your greatest allies. Seeing the numbers can be emotional. James runs the math on what could have been, Linda reflects on her foundation, and Aisha enjoys the options her early start gave her. The emotional impact of investing early is real: regret for waiting, pride in consistency, and hope for the future. Linda's advice to everyone is simple: start right now. Don't wait for the perfect moment or the perfect plan. Begin with what you can afford and let time do the rest. The sooner you start, the more you gain. This is the most important lesson from all three stories. The plan is simple: $300 first of the month, automatic transfer, index fund, repeat for as long as you can. This approach removes complexity and emotion, making it easy to stick with. Over time, the results speak for themselves. Depending on when you start, this plan can change your life or your children's lives. The impact of consistent, automatic investing is profound. It builds wealth, creates options, and provides financial security. The only question is when you begin. Time is the one resource you can't buy back. Larger contributions later can't compensate for lost time. The best time to start is now, while you have time ahead of you. Every year you wait, you lose the compounding power that could have transformed your portfolio. The entire plan is straightforward. $300 automatic index fund repeat. No need for complex strategies or market predictions. Consistency and time are the only requirements. This simplicity is what makes the plan accessible and effective for everyone. Starting today means giving your money the maximum time to grow. Every month you invest, you're building a foundation for your future. The earlier you begin, the greater your rewards. Don't wait, start now and let compounding work for you. The final visual shows Linda, James, and Aisha's portfolios side by side. The difference is striking and the lesson is clear. Time is the most powerful force in investing. Consistent, automatic contributions over decades create wealth that changes lives. The best time to start is now. If one number in this video shifted how you think about your money, remember, every week we run the real math on financial decisions. You don't have to figure it out alone. The lesson is simple. Start investing as soon as you can, stay consistent, and let time do the rest. Your future self will thank you.